So, I know SpaceX has had some divided opinions since its record-breaking IPO, but with its recent inclusion in the Nasdaq 100, you may actually be holding some shares in SpaceX without even knowing it. And in this video, I'll just highlight some of the ways that you can currently gain exposure if you're interested in SpaceX, and then some instances where you may now be forced to own a small portion of it in your own portfolios. But before we get started, if you're interested in Canadian covered call ETFs and passive income investing, consider subscribing to help out the channel in reaching 5,000 subscribers by the end of the year. There are a lot of viewers who have yet to subscribe, so it'd be appreciated if you could help out in reaching this goal. And with that, let's get into the video. For a company that just recently IPO'd less than a month ago, this is the fastest we've probably seen it to not only sprout multiple ETFs as soon as the next business day after its launch, but also be the fastest to be included into the Nasdaq 100 index. It took SpaceX just 15 trading days to be added, after the index changed some of its inclusion rules shortly before the IPO. Now with the launch, SpaceX already sits well within the top 10 largest companies in the world by market cap, surpassing Tesla and other popular mega cap stocks. So as you can see, there is a lot of hype and interest in SpaceX, and so I figured for those who would be interested, this would be a way to figure out how you could get your exposure to it. To make things easier, I'll group all the different ways into 4 categories, so you can hopefully pick the right one that meets what you are looking for in terms of exposure. The first would be the pure play single stock covered call ETFs. Then second would be the multi-asset aggregators. Following that, you'll have the index-based ETFs. And lastly, it would then be the pure equity alternative. To begin, we'll start with the first category, and that is the leveraged pure play single stock covered call ETFs. This is the category where the fund holds 100% direct exposure to SpaceX with modest leverage, and then uses covered calls to generate income on a portion of the portfolio. There are only 3 main providers that specialize in single stock covered call ETFs, and that would be Purpose Investments, Harvest ETFs, and Ninepoint Partners. You might think that why would there be a need for 3 of the same type of ETF, but there are actually distinct features that make each of these unique from one another. With all 3 of these, you'll have 100% exposure to SpaceX, as these are single stock ETFs, so that will be one of the main things common between them. The other would then have to be their distribution frequency, where all 3 of these will have monthly distributions. Then, these next few details are where they will start to differ. When it comes to the use of leverage, Purpose and Harvest use more of the traditional 25% leverage. Ninepoint, on the other hand, uses just a bit more, at up to 33% leverage. So, of the 3 ETFs here, this one might be the one that will swing a bit more when it comes to its overall performance. What this means is that when the underlying stock goes up, this might go up just a little bit more. But the opposite is also true, where if the underlying stock goes down, then this might go down a little bit more than the others, so that's just something to keep in mind. Then next would be the currency hedging aspect. While this is a bit more nuanced, it isn't something that can be controlled, and you just have to decide between the 2 choices. For this, you can either pick the Canadian dollar hedged version or the unhedged version. This just means that for the Canadian dollar hedged version, the fund uses special financial contracts to lock in the exchange rate, such that the overall performance of your investment is purely based on the underlying assets rather than fluctuating with the exchange rate. So if you only want to have just the performance of the underlying, then this is what you would want to go with. But if you think in the long term the US dollar will outperform the Canadian dollar and don't mind the added exposure to the exchange rate, then the unhedged version could be what you would be interested in going with. So to try and summarize it in simpler terms, in periods where the Canadian dollar is stronger than the US dollar, the Canadian dollar hedged version will perform better. And in periods where the Canadian dollar weakens, then it would be the opposite, where the unhedged version will then perform better. So when it comes to these specific ETFs, it looks like Purpose Investments will be the Canadian dollar hedged option, and then Harvest and Ninepoint will be the ones with the unhedged versions. The next differentiator would then be the fees. For Purpose and Harvest, they will both have the same management fee of 0.40%, so that makes it easy for comparison. Ninepoint, on the other hand, currently has a 0% management fee until September 30th, 2026. After this, it will then be a 0.29% management fee going forward, which would be lower than both Purpose and Harvest. Just keep in mind that total returns are net of fees, and that the management fee is only one part of the total management expense ratio. So unfortunately, that isn't something we can compare right now, as these are too new, and it's something we'll only find out once these reach their 1-year anniversary. But for the management fee part of it right now, Ninepoint is the lowest one out of the 3, and will also be true afterwards when the 0% promotion goes away. The next part we'll go over will be more complicated, and that is the covered call strategy of each ETF. This is likely going to be the most important part when deciding between these 3, as they all vary slightly enough from one another that it really depends on what your objective is going to be. But also, as I go through these, each of these ETF providers actively manage these portfolios. So even though these are going to generally be the strategy they adopt, it is flexible and can change depending on the fund manager's discretion based on the current market environment. So I'd keep these in mind as guidelines, and not as exact rules where they will systematically follow on a regular basis. Starting with purpose investments, they typically have a coverage ratio closer to 50% of the portfolio. While this may seem a bit high on the surface, there are other components to the strategy which will help to mitigate that perceived potential of being capped on the upside when it comes to the total returns. First, it would be the strike price selections, where they choose between at the money and as far out as 5% out of the money for their calls. This means that if there are strong moves upward in the market, they'd be able to capture more of that upside, rather than it potentially being capped. Along with the varying strike prices, they also have multiple expiration dates when it comes to their time to maturity. So all of this is to say that their covered call strategy, while it may have a high coverage of up to 50%, the other attributes of it when it comes to the moneyness, maturity, and laddering lowers the risk of being significantly capped when compared to other strategies that may only choose 1 or 2 strike prices and closer to the money. But given this, as they tend to favor more of a total return profile, their yields are typically on the lower end as a result. So at the current distribution amount of 50 cents, and a current NAV of $17.78, the yield for SPXY is 33.74%. Then next, we have Harvest ETF's SPXE, and I'm sure many of you are probably already aware of what their approach is. But as a refresher, they also have listed that they can have a coverage ratio of up to 50% as well. But typically, this is just for flexibility, and a majority of the time, they are actually closer to 33% to 35% coverage on the portfolio. As for the moneyness, they target closer to at the money, and somewhere around 1% to 2% out of the money. They also stagger some of their options, writing every 2 weeks with 30-day expirations. So, compared to purpose, they don't do as many calls. Instead, they choose to write on less of the portfolio but closer to the money, in order to generate higher premiums and therefore slightly higher yields overall. And at the current distribution of 30 cents, and a current NAV of $10.44, the yield for SPXE is 34.48%. Then, lastly, we have SXHI from Ninepoint. Already from the extra leverage it uses compared to the other 2, you can make a guess that it leans a bit more aggressively towards the yield side of things. For their covered call strategy, they have a coverage ratio in the 40% range, and upwards to a max of 50%. With their strike price selections, they can range anywhere from at the money all the way to 7% out of the money depending on the market environment. It's also a laddered approach, where they use monthly expirations written on a weekly basis to spread out the coverage. Based on a current distribution amount of 23 cents and a NAV of $7.15, the yield for SXHI is 38.60%. So overall, this should give you a clearer picture of how these differ, and are fairly distinct from one another when you look at it on a high-level view like this. Next, we'll now go over the multi-asset aggregators, and what options you would have here for exposure to SpaceX. Now this category is for those who would like some exposure to SpaceX, but more so as a complement to an existing basket of other popular names as well, to form a high-yielding all-in-one ETF. This way, there is a bit more diversification, and so that you're not exposed to the risk of only a single stock. There are 2 main ones that I'll go over, and they are hhis and BIGY. Both of these ETFs added SpaceX to their holdings in recent weeks, and while SpaceX isn't going to be the main reason for adding these to your portfolio, it does add a bit of diversification by providing exposure to the various components that now make up the overall company, such as space infrastructure, connectivity, artificial intelligence, and data center capacity. And at the time of putting this video together, SpaceX only makes up a small allocation within each of these ETFs. For hhis, as of June 30th, 2026, SpaceX is only a 3.5% allocation, so it sits among the bottom half of the overall portfolio when it comes to exposure. But with its inclusion, hhis actually had to replace another holding for it. This is because while I believe there is no longer a cap to the number of holdings that can be within hhis, they've opted to keep it at 20 holdings in order to maintain the overall objective of providing both growth and income. So, to make room for SpaceX, they've decided to take Netflix out of the holdings of hhis. Then, now looking at BIGY. This one has gone through a lot of changes in the recent weeks, where they've now decided to more than double the number of holdings within the portfolio in order to provide some more diversification overall. At inception, BIGY started out very concentrated with only 10 underlying holdings, but now it's grown to 23 holdings at the time of making this video, and among them being added is SpaceX. Again, similar to hhis, as of July 9th, 2026, it currently only makes up a small allocation of 1.74% in the portfolio, which places it in the bottom 5 in terms of size. So this isn't going to be a huge driver of returns, but again adds some more diversification to the overall basket of holdings. Then, the next category we have is the index-based ETFs. This was originally going to just be the Nasdaq 100 index-based ETFs, but I've also decided to include another sector-based index one as well. Technically, this was something that couldn't have happened before, but as SpaceX's IPO date was approaching, the Nasdaq index itself decided to adjust some of their rules for inclusion into the index, so that it could fast-track the addition of SpaceX, as soon as just 15 trading days. What this means is that any ETFs or indexes that specifically track the Nasdaq 100 will be forced to add it to their own holdings as well. So any ETFs you may have that follow the Nasdaq 100 index will automatically mean you will now hold some exposure to SpaceX. The most clear one that comes to mind for covered call ETFs would have to be Global X's QQCL, which is their leveraged covered call ETF based on the Nasdaq 100. While QQCL won't hold SpaceX directly, it in turn holds QQCC, which is their Nasdaq 100 covered call ETF without the leverage. And then for QQCC, it'll then hold the actual Nasdaq 100 index itself in QQQX, which is where they'll likely be adding SpaceX. Then the other way you can add SpaceX in the form of an index would actually be another one of Global X's ETFs, but this time it would be in the form of a sector-based index ETF with the ticker ORBX. While this isn't a traditional broad-based index, it is more of a concentrated index focused on space and technology companies. ORBX actually only launched in Canada just a few months ago, so it's still relatively new. I should also note that this isn't a covered call ETF, so there are no distributions or income if you decide to invest in this. But prior to SpaceX's IPO, the largest holding I believe was in Rocket Lab, but now the top spot has been taken over by SpaceX, and as of July 9th, 2026, it is a 19.58% allocation overall. In comparison, Rocket Lab only makes up 9.63% of the allocation, so SpaceX is more than double the weighting. But while it may seem quite concentrated based on these values, the ETF actually holds at least somewhere between 20 to 30 holdings in total. So while SpaceX will influence the performance of this ETF the most, it does still hold numerous other companies within it, although all being concentrated in the same sector. Then, the last category in which you can gain exposure to SpaceX is the simplest, and that is the pure equity alternative. There are no covered calls, leverage, or yield with this, and it is just as if you're investing in the underlying stock itself, but in Canadian dollars. This is done through a Canadian Depository Receipt, or CDR, where it allows you to buy shares of top global companies in Canadian dollars on Canadian stock exchanges, and as such, they are typically all Canadian dollar hedged. Along with this, they are also offered at a lower entry price point when compared to buying the actual stock in US dollars. So this would be good for those who just want to invest in SpaceX for its full growth potential, without any other strategies aside from the currency hedging aspect. And with that, what do you think? Have you considered or are already invested in SpaceX through one of these methods? There might be some others listed that I may have missed or will launch after this video is posted, but generally these are the 4 categories you can probably expect them to fall within. Don't forget to like and subscribe if you found this useful, and would like to follow along for future videos. Thanks for watching, and and I'll see you in the next video.